What a start to the week with some very large names down double digit. In fact, one of the largest impacted industries, the semiconductor space, Nvidia notably down 16%, Broadcom down 17%, as well as others, Micron there a mention as well, down nearly 12%. If we look at Nvidia, it is trading at around $118 to $119, continuing to come down as the day progresses, but over the last year, it is still up around 93%. Over the last 10 years, still massively outperformed the S&P, but we do notice right now it is on a pullback at the midpoint of the 52-week range, at that $153 sitting at its all-time high. Nonetheless, Wall Street do still give this company a strong buy as well as seeking alpha, and we want to understand why has this company dropped. Well, in fact, we have many articles, Forbes in fact calling it the biggest market loss in history as Nvidia plunges 15% as DeepSeek shakes the AI darling. We have the Financial Times saying Nvidia leaves a big sell-off in tech stocks at the Wall Street Open, and CNBC mentioning China's DeepSeek AI model sparking global tech sell-off. Now, ultimately, what this has come down to is DeepSeek, which is a free open source large language model, very similar to ChatGPT, and it has been claimed it was developed in just 2 months at a cost of under $6 million, which is actually very trivial in comparison to the amount spent on ChatGPT as well as other comparable projects, which has got the market very worried, as we can see here, questions about the large amounts of money that have been spent by the big tech companies. We have the likes of Meta, Google, Amazon, Microsoft, and all of these putting a lot of money into artificial intelligent models as well as data centers, yet DeepSeek has come along here in just under 2 months, supposedly not verifiable at the moment, and at a cost of under $6 million. Now, we do have a Forbes article that actually goes to talk about DeepSeek and why this is essentially affecting Nvidia, and the main reason that we have just touched upon is concerns about competitive pressure from DeepSeek, the Chinese startup that has developed an AI model called R1 that rivals those from major US companies, as we said, OpenAI and Google. Now, they do mention a few different reasons, the first one being efficient AI without advanced GPUs. Now, their R1 model does achieve results comparable to AI systems based in the US, but supposedly does use less powerful data, which raises fear that DeepSeek and similar companies can ultimately drive away demand from Nvidia's high-end GPUs, which are critical for training and running AI models. Now, this breakthrough news has caused investors to question whether Nvidia's dominance in the AI chip market may face challenges if AI developers prioritize efficiency over raw power, and ultimately potentially reduce Nvidia's growth prospects in the AI sector, hence why we have seen the massive drop on the share price today. We also could see a ripple effect on AI investments. The developments by DeepSeek may prompt a shift in how companies invest in AI if others do follow their approach of using less advanced chips to achieve high performance AI. It could ultimately undercut the demand for Nvidia's premium GPU products, and no surprises here, but it does also highlight the increased geopolitical competition in the tech industry, especially between China as well as the US, and the development has effectively fueled many concerns about Nvidia's ability to maintain their leadership in the face of growing global competition. We do want to show you this graph here that does show a side-by-side comparison of the DeepSeek R1 model against OpenAI, which is used for ChatGPT, and effectively they are using less powerful data, spending a lot less money, and coming up with very comparable results. Now, this is something just to consider, but we want to understand, has the market overreacted? Are we looking at a golden opportunity to buy this AI giant at an incredibly cheap price? Something, again, let's focus on and jump in today's episode. They are going to be reporting their earnings, that is Nvidia, at the end of market close on the 26th of February, so something just to watch out for. But as we do know, they are expecting large growth over the next 4 quarters, double digit to be precise for the upcoming quarter, 64% increase on the year-on-year comparable. And also, you could argue you do have faith, given over the last 4 quarters, they have outperformed 100% track record. And if we look to their next full year, January 2026, with the EPS estimate at 4.45, that does right now mean this company is trading at a 32 forward P, which is actually cheap in comparison to their historical average. Now, while we will highlight that the 32 is above the sector median of 26, meaning you are paying a premium, one thing we would say, some companies deserve the premium. We believe Nvidia is one of those, but what's very interesting to note, and we will come to show you again in a graphical format, but Nvidia is trading substantially lower than their 5-year average. Now, it will depend as well which valuation metric you do use, but the common denominator here for the valuation aspect of Nvidia is that it does trade at a premium. Now, you could be satisfied that it is worth it given the growth does look very strong at an A+, but remember, issues we are discussing today about DeepSeek could trickle into their numbers and ultimately affect their long-term prospects. Year on year though, over the last 12 months, their revenue is up 152%, above the sector of 4.5, above their 5-year average of 60.4. Revenue forward looking, they anticipate 94%, well above the sector comparable of 5.4, so yes, they do deserve a premium. We will come to see what level we believe when we run it through our DCF model, but we also notice it is above their 5-year average, and the same to be said for the earnings per share. They anticipate 38% growth year on year, well above the sector comparable at 15.2, but also above, as we can see here, their own 5-year average. Finally, we do want to highlight their profitability looking very strong, 76% gross margin, better than the sector at 50.5, better than their 5-year average of 65, and the same to be said for their bottom line, 56%, well above the sector at 3.8, well above their 5-year average of 33%. And again, lots to love about this company. Very, very strong data from the cash from operations. They're generating 59 billion, well above the 94 million of the comparable, and well above their 14.3, which is their average over the last 5 years. We will, however, point out that whilst institutional ownership sits at 65% and they have been selling 40 billion, in fact, in comparison, buying a lot more at 293, again during the same time frame of over the last year. Just in the most recent quarter, institutions did sell more than 3 times than they did buy, 9.9 billion worth of shares sold versus 2.96. Just something to consider, but it is interesting to note as this has come just before all of this DeepSeek information has been released. And we also notice, not something surprising given how much coverage this does get, but their insider ownership of 4.2% does actually show us quite a significant amount of sales over the last year of 1.09 billion. And in the most recent quarter, so just in January alone, we've seen 5.51 million worth of sales, with the previous quarter of 177 million. Now, we will show you for full transparency who these insiders are, but bear in mind this isn't something that we personally use, as they sell for many reasons, personal and financial. We can see here on the 6th of January, the EVP did sell around 36,000 shares, netting them around $5.5 million. If you did watch actually one of our previous episodes over the last week, Nancy Pelosi, one of the best investors in our generation, on the 14th of January actually bought quite a number of shares of Nvidia, topping up her current allocation. Again, just something to bear in mind. We always need to do our own due diligence before buying or selling any shares. We do also want to reiterate the fact that when we look at the valuation based on the 5-year average of the forward P, that the blue tunnel does indicate here the expected fair price. Right now, and for the first time in a long time, it does sit significantly lower than even the bottom end. This is what we would call a massive and severe undervaluation signal. We also do want to highlight that when we draw your attention to the forward P, right now it sits below 1, which is significantly lower than the 5-year rolling of 42.9. Again, another massive severe undervaluation signal. Very quickly then, we can just touch upon their metrics, which, as we have said many times, is of a very high quality. In fact, their free cash flow, whilst it hasn't been consistent growth, has really propelled over the last few years and is anticipated over the next 12 months to in fact more than triple from the 2024 position. Their sales growth, whilst fairly inconsistent, has seen some very strong growth over the last 10 years. In fact, in 2024 and expected 2025, triple-digit revenue isn't something that we should be surprised if we come to see. And there we get it in terms of their total sales. It is anticipated for the full year of 2025, which actually, for those that don't know, their accounting period ends January 2025. We are anticipating triple-digit around the 100+ billion mark, and just the previous year, they did in fact report 61 billion. They have also diluted your position as a shareholder over the last 10 years. One thing we would say though, you probably wouldn't ultimately care given they have massively outperformed the S&P over the period. ROIC, very, very strong, way above the 12% that we want as a minimum for the semiconductor, 92% in fact on a trailing 12 month. And on the operating margin side, you know we come to love companies that are not just above the minimums, but show the efficiencies going from 16% to 63% on a trailing 12 month. And the free cash flow, a definite free cash flow machine, 50% in the trailing 12 month. Finally, net debt to EBITDA, this shows us 0 right across the board. It won't even take this company one day to pay off all of their debt net of cash on hand, which tells us they have a very, very strong balance sheet. Just before we jump into the DCF valuation model, we want to let you know we've released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to undervalued stocks for the month of January, 46 in fact, the upside that Wall Street themselves see over the next year. We are dropping a new copy in the next few days for February, as well as a recently released copy of 43 stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. We now want to move on to the intrinsic value, where we get to just under $180 derived from the DCF model. Now, as you can see here, we have the free cash flow year on year. Over the last 10 years, it's grown by 94% compounded annual growth rate. Over the last 5 years, triple digit at 135. Now, we're being very conservative at the 25% point. We have highlighted on previous episodes, even 2025 figure is significantly lower than what they actually anticipate, so extremely conservative today. And with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and $180, indicating 50% upside. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others. But full transparency, for those that are a lot more conservative, at the 20% point, intrinsically $134, indicating 13% upside. At the 30% point, we can see here $240, 101%, meaning a double from the current value. And Bloomberg last year reported that they see this industry growing at 42% year on year. If we were to apply that, again, just something we do as an exercise for fun, intrinsically $464, 290% upside. That right there is more than a quadruple from the value. So what we like to do on this channel is take the medium rate of 25%. We don't stop there, as we do like to apply a margin of safety. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $162, but what we like to do is keep going till it's near the current trading price, and we can actually see in today's episode, not a 35% MOS, but sitting somewhere between 30 to 35. But remember, maybe the margin of safety you want in today's episode is higher, given the issues that we have discussed about DeepSeek, the Chinese startup that have developed their AI model R1, which could ultimately rival those from the major US companies like OpenAI as well as Google. In terms of Wall Street though, they're still very bullish. Their price target, as well as the strong buy rating of $177, translates to 49% upside over the next year. But as always, do give us your thoughts in the comments below. Is this one you are buying the dip on this massive drop we have seen today? Maybe this isn't a company for you. Maybe in fact you will just load up on your semiconductor ETFs like SMH, like SoxQ, or for whatever reason it isn't one you are considering. As always, give us your thoughts. Don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon. We did make some buys today, which we have discussed, so click below. And as always, have a great day. We'll see you all on the next one.